Hello and welcome to Business Arena on TVP World. I'm your host, Marie Caso. Join me for the latest business headlines of the day. Hungary has requested that the U.S. exempt natural gas payments from the sanctions imposed on a Russian bank responsible for handling energy-related transactions. The country relies on Russian energy for much of its needs, including oil, natural gas and uranium. The request was made by Hungarian Foreign Minister Péter Szijjártó, who urged the U.S. to grant an exemption similar to the one provided for Russian uranium purchases. In November, the U.S. blacklisted the Russian lender Gazprom Bank, cutting it off from the U.S. payment system. This spells trouble for several EU countries, including Hungary, which relies on Russia for approximately two-thirds of its natural gas supply. It's worth noting, however, that sanctions on Russian banks like Sberbank have special provisions that allow them to process payments for Russian energy up until next year. Slovakia's underwhelming GDP figures today came in as no surprise to most observers. They mirror recent results from across the CEE region, which is experiencing a bout of pessimism just before year-end.
Slovakia's Q3 GDP figures are in, and they paint a fairly bleak picture. Its Q3 GDP grew by 1.2%. That's down significantly from the start of the year, when it was at 3.3%. And when we look at the trajectory, it's pretty steep in the downward direction.
So the third quarter data act as a warning signal, not only because of the slowdown in external demand, but also because of a notable weakening in terms of the investments.
This result is a warning signal not just for Slovakia, but for the entire CEE region and the Visegrad 4 in particular. Third quarter GDP figures have come in below expectations for all concerned. We see an enormous disappointment in Hungary, which is currently in a technical recession. Slovakia came in way below expectations, as did Romania, the Czech Republic, and, to a certain extent, Poland.
What is pulling Slovakia back is the fiscal consolidation, which is quite significant in size, and also some challenges on boosting growth via investments and the EU funds, because they have some issues with implementing reforms that are conditional on getting the next tranches of NGO funds. And here, this is limiting investment activity growth.
Juraj Valaki from Tatra Banka argues that the fiscal changes were a necessary sacrifice.
So from the one side, we can say, yes, the growth will be lower, but on the other side, which is more important, that public finances will be finally on the track to become sustainable in long run.
There are two key issues which are common to the entire region, however, and those are continuing declines in fixed capital investment and weak external demand due to a slowdown, particularly in Germany. Quarter-on-quarter investment dropped by 14% in Hungary, 8% in Slovakia, followed by the Czech Republic with a 0.8% drop. Poland remained positive at 0.1%, but that's a big drop from 3.2% in the previous quarter.
Corporate investments have seen weakening, which again reflects the more worrisome outlook of the corporates.
For now, most forecasters agree. Economic growth will pick up in 2025, but only slightly.
And as we edge closer to the year-end, more conclusive GDP numbers are emerging for the Central and Eastern European region. Today on The Bottom Line, we'll look at third quarter GDP figures for Poland and its regional neighbors. Stay with us for The Bottom Line, coming up right after the news. The governor of the Czech Central Bank has signaled that the pace of interest rate cuts may slow down, reflecting concerns over lingering inflationary pressures. The declaration comes on the back of a new budget, which aims to reduce the deficit. Governor Aleš Michel released a statement that claims while inflation has fallen within the central bank's target range, core inflation remains a challenge, preventing further rate reductions. The benchmark rate in the Czech Republic has been lowered by 3 percentage points over the past year to 4%, delivering the 8th consecutive cut last month. The next monetary policy meeting is supposed to take place on December 19th. Meanwhile, on Tuesday, Czech lawmakers approved a tighter budget for 2025, which includes measures to lower the deficit. The fiscally conservative move comes on the back of an election year in the Czech Republic. The government has so far managed to slash the deficit by around €7 billion since 2021. The Czech Republic stopped receiving oil from Russia on Wednesday. The country's only refiner said that the Russian supplier was at fault for the stoppage.
This is the Druzhba pipeline, also known as Friendship. It is the sole route for Russian oil to reach the Czech Republic. On Wednesday, however, pipeline flows to 2 Czech refineries were halted and remain suspended as of Thursday afternoon. Deliveries to Slovnaft, a Slovakian refinery also supplied by the Druzhba pipeline, continued uninterrupted. Orlen Unipetrol, the Czech Republic's only refiner and a subsidiary of the Polish energy giant Orlen, said that the supplier was to blame.
We register a delay in current deliveries of crude oil flowing into Czech Republic via the southern line of Druzhba pipeline, and this delay is beyond the Orlen and Orlen Unipetrol control because we have fulfilled all the financial and technical conditions as usual.
Although the company currently has about a week's worth of oil reserves, it has been allocated 300,000 metric tons from the Czech National Strategic Reserve.
As a preventive measure, we have just asked the Czech state for a potential loan of crude oil just to secure the production and the delivery of fuels to the Czech market.
Currently, refining is continuing uninterrupted, and officials say the additional supply will be enough for over a month of production. Flows from Russia currently account for nearly 60% of the country's oil demand. However, this is set to change, as the Czech Republic has announced it will stop buying Russian oil in 2025. To meet future demand, increased supplies are expected from the IKL pipeline, which is connected to the TAL pipeline, which runs from the Italian port of Trieste and is partly owned by the Czech Republic. This comes a few days after a spill was detected in the branch of the Druzhba pipeline that runs through Poland and transports oil to German refineries.
Danish brewing giant Carlsberg has officially exited the Russian market, selling its subsidiary Baltica breweries. This ends a battle over the ownership of the company, which began as a consequence of the Russian full-scale invasion of Ukraine in 2022. Carlsberg sold Baltica breweries to VG Invest, a Russian company established only in August by one of the former executives, for approximately $320 million. This price is notably lower than Carlsberg's previous valuation of over $1 billion for its Russian assets. VG Invest, led by Yegor Guselnikov, vice president of Baltica, reportedly has ties to Taimures Bolyov, a former Baltica president and close associate of President Vladimir Putin. The sale follows the Russian government's temporary seizure of Baltica in 2023, a move Carlsberg CEO Jakob Arup Andersen denounced as theft. In the sale to VG Invest, Carlsberg will additionally receive Baltica's shares of businesses in Azerbaijan and Kazakhstan. And that's all for our business news updates today. For more business stories, check out tvpworld.com.